Hi, I'm Tom Nunamaker with Aeromir Corporation. Welcome to our new series, Beyond the Backtest, where we look at strategy metrics that actually matter. And the first lesson we're going to talk about is the K ratio, which is consistency of returns. Now, before we get into it, a general disclaimer that Aeromir is not a broker-dealer or investment advisor. It's for educational purposes only. Options, futures, bonds, and currencies involve risks are not suitable for all investors. We do have some back-tested hypothetical performance results, so be aware of the disclosures for these. And quick, who am I? I created Aeromir in January 2018. My first options trades were in 1982. I've been trading options and futures for a long time. Started programming in 1974, so it's been over 50 years. And I'm a retired Air Force pilot. So what are we going to talk about? Why backtests alone are not enough. And we're going to cover quite a few things in the series. I anticipate it'll be quite a few lessons, but we're going to talk about lots of different things. But today we're just going to start with one that we're going to answer the question, how good is this equity curve? So the equity R squared is the correlation coefficient is 0.945. 1.0 is a straight line. And you can see the straight line is plotted here. This linear fit line is on the chart, and then the question is, there's a big dip in here, is that okay? And it started below zero actually, and is that okay? So overall it looks pretty solid, but let's get some numbers to find out if it is solid or not. So to answer the question, yes, it's fine, and here's why. The dip happens around trade 1100, which is roughly year 8 to 9 of a 17-year track record, and this is the Aspen strategy. It's an ES futures 30-minute bar strategy. And the strategy recovers and continues climbing. The long-term trend is unchanged. The linear fit line barely notices it, which is exactly what R squared of 0.945 is telling you. That period around late 2018 was a sharp 20% sell-off in ES. The strategy took a hit, but kept trading and recovered fully. The fact that Aspen had a dip and kept trading rather than blowing up is actually a feature and not a bug. So let's introduce the K ratio. It was developed by Lars Kessner in 1996, hence the K and K ratio. It measures both the slope and consistency of the equity curve. So unlike R squared, it also rewards steady growth over time, not just linearity. Think of it as R squared with a bonus for making money consistently. So what hurts your K ratio? Long flat periods with no progress, deep drawdowns that take months to recover, erratic quality, big up months followed by big down months, and a strategy can have a decent net profit but terrible K ratio if the path there is ugly. So let's compare K ratio versus R squared. What's the difference? So the chart on the left is, well, both charts are actually fairly straight. And the R squared is basically saying how close is this to a straight line. And 0.97 and 0.98 is great for both of them. However, the K ratio of the one on the left, the flatter one, is 0.6. So the slope is too flat. It's not rewarding growth because there is no growth. It's acceptable, but it's not ideal. The one on the right is a steeper slope and it's consistent, and that's giving a higher K ratio, 3.2 versus 0.6. So again, R squared only asked, does the curve fit a line? And K ratio asked, how steep is that line? And both need to be high. So K ratio definition and formula, K ratio is punishing inconsistency. A $100,000 profit in a straight line scores better than $100,000 with wild swings. The formula, K ratio, is the slope divided by standard error times the square root of the number of trades. So the slope, or first derivative, is how fast is the equity curve rising. The standard error, how much it wiggles around that growth line. And the square root of the number of trades adjusted for the number of observations. So how steeply is the equity curve climbing divided by how erratically it gets there? That's the K ratio. And note, you don't need to calculate this. Your strategy testing software should do it for you automatically. And the tools I have at Aeromir automatically calculate the K ratio. So there is a time frame caveat. So remember, part of the formula is square root of number of trades. So because that's in the formula, it's sensitive to that. So 50 trades versus 2,000 trades will score differently, even with similar equity curve shapes. So remember this, more trades equal more reliable score. And always consider sample size alongside the K ratio. So when you're looking at K ratio, make sure there's a sufficient number of trades. And you can see on the chart below, it has the range of 0.6, 1.4, 2.2, 3.1, 3.8 as the number of trades increases. So K ratio is rewarding that larger number of trades. So how do we use it practically? First, use it as a filter when evaluating any new strategy. So somebody gives you a new strategy, first thing you ask, what's the K ratio? And if the K ratio is below 1, ask why before going any further. And you can see on the flow chart, once you get down to the decision diamond here, if it's below 1, it's yes, ask why before going any further. And then you can do further investigations like flat periods, drawdowns. Why did it score so low? If it scores above 1, then you can compare with other strategies against each other, not just the benchmarks. And then use it alongside with net profit and drawdown, never in isolation. So this flow chart kind of guides you as to when and how to use it. So what are the benchmarks? So K ratio below 0.5 is really bad, avoid it. 0.5 to 1 is acceptable, but you need to ask questions and really examine it. 1 to 2 is good, 2 to 3 is very good, and above 3 is excellent. So the bottom line, most retail strategies never exceed 1.0, and institutional grade strategies typically score above 2. So let's talk about Aspen and Phoenix. Aspen is an ES 30-minute bar, 17-year tested strategy. Phoenix is an NQ 5-minute bar, 6-year of back testing. Phoenix, again, has more noise because it's an intraday day trading strategy with a 2.87 K ratio, which is still really good. And Aspen is a swing strategy. It holds trades overnight. It's not really for day traders. It's more for option traders or investors. But 8 is really outstanding. That's exceptional. So what's next in the series? So next time we're going to talk about profit factor. And a strategy might have a 2.5 profit factor, and you think, wow, this is really great. But then all of a sudden it just goes berserk and blows up your account. So we're going to show you exactly how and what to look for instead of just profit factor. And I mentioned Phoenix is part of the Aeromir Auto Traders. You can go to features.aeromir.com/products and learn more, see the current performance and pricing. You also have access to all of our legacy auto traders too, and people are still trading those. And on Saturday, the 4th of April, I'm teaching a one-day class, the Algo Method, on building an automated strategy of your own, not relying on somebody else. So this is going to be from start to finish, soup to nuts. I'm going to start out with my data exporter, which you'll have access to these for life, which you can take any NinjaTrader chart and export all the open, high, low, close volume data, plus calculate VWAP numbers and also export any indicator values. It also includes my converter to convert the build alpha output from unmanaged to managed orders in NinjaTrader. And you get access to the Phoenix Auto Trader, in fact, all the Aeromir Auto Traders for a month. So you can play around with those and see how they work and while you're developing your own strategies. And lastly, the Phoenix trade alerts are coming soon. They're in final beta testing right now. If you go to aeromir.slack.com, you can join our free Slack community, and you'll see the public Slack channels for the Phoenix alerts. I am sending out ES and NQ alerts. NQ has slightly higher win rate, about 67-68%. And ES and NQ on 5 minutes are correlated about 93 to 95%. So if NQ is going up, ES is almost certainly going up as well. And it works out really well if you're trading SPX options, for instance. If you get a signal on Phoenix to take an SPX option trade, say a vertical, sell like a vertical spread and try and buy it back for 50 cents less than what you sold it for and make 50 bucks. And generally they work out pretty well. So right now it's free, pre-launch beta. I anticipate a $99 charter price when I launch, which will probably be in a few weeks, probably before the end of the month. But again, we're in final testing right now, but everything seems to be working fine. So just go to aeromir.slack.com. And that's it for now. For next time, again, we're going to talk about profit factor. So have a great day. We'll see you next time.